Volatility cannot settle down without volume. And so what that means is the price of Bitcoin has to get high enough to where there's so many people in it that it starts to stabilize itself. There's a woman named Kathy Woods who owns an investment company called ARK Invest, and I like how she positions this. And I could never regurgitate all of her information, but she basically says when Bitcoin hits about $400,000, it will have enough liquidity in the marketplace to control or to add some stability to it. The reality is Bitcoin's extremely stable. It's actually more stable than the dollar, but it doesn't look like that because you're only comparing Bitcoin to the US dollar. And so that's what's causing the swings. Obviously, when more money is printed, it changes the valuation of the dollar. Bitcoin, it's not going to be increasing. So from an exchange rate, yeah, it absolutely shifts. But as it gets higher up there, it'll start to stabilize a little bit. So one of the things that we look at is kind of price levels, right? There's what's really funny about trading any asset is there's a psychological level to everything, right? Like, for example, if I told you right now, hey, would you be interested in buying Bitcoin at 50 grand? What would you say?
Nope.
But if I said, hey, I can get you one Bitcoin for 10 grand, would you be in or out?
Absolutely.
You'd be in, yeah, because your brain is telling you, it sounds very simplistic because it is, but and that's an extreme example, but it literally even happens on this time frame, right? Like if it's 32,000 some odd dollars right now, there's psychological levels $4 from here, $2 from here. It just depends on what you're looking at. So if it's at $32,000 now and it might go down to 28,000, now it's a pretty good chance to buy, knowing that we know we're going to go back up and at a bare minimum test this 64,000, right?
Okay.
But if that breaks, right, if it breaks below that, people start selling, then the next real resistance is really this $20,000 range. And so it just boils down to what are you trying to do? Now, me personally, I've got some cash I'm trying to deploy, and I've been waiting. So the closer it gets to 30, the more money that goes in there. If it goes under 30, the more money goes in there. And then if it goes under 28, I'm going to wait until it gets closer to 20 because it will go pretty much all the way down to 20. You can actually do this in inverse, but it's more speculation. When it's coming down, you can be when the prices are coming down, you can be very confident in where it's going to stop, simply because we've already been to those levels before, right? I already went up and I came back down, and this level right here, for whatever reason, was low enough to say the market holistically is like, this is too cheap. We got to buy this thing. So it started buying it up, and then they said, this is too expensive. And then they sold it, and this is too cheap again. You see what I'm saying? Like that's all this is. And when we look at kind of a macro approach like we're looking at now, it makes it a little bit easier to kind of see. We're talking about, you're not trying to day trade this thing. You really just need to know, I want to deploy more capital into it. When should I be getting in? Well, here's what happens if you're wrong. If you're wrong and you get in now and it's 32,000, it goes down to 20. Well, you potentially lost $12,000 if you bought a whole Bitcoin. But at the end of the day, it's going to bail you out. So it's not really that big of a concern. And also we have still almost a whole month left that we can stay in this range and still be on track for the last bull market. So, I mean, we're so ahead of the pace right now that it's confusing people. And so because we went up too fast, well, now what goes up has to come down. And you've probably heard on YouTube then as well that this is very similar to what happened in 2013, right? Where it went up and then it sold off, and then all of a sudden it had a really big spike, right? And I think that we could absolutely see that because, again, the faster it goes up, the faster it's got to come down. But it doesn't change the fundamentals of Bitcoin in that fact that there's a 4-year halving, and all these miners have been receiving all this crypto, all this Bitcoin as a reward for the last couple of years. When do they want to take profits? Well, when it starts to get more expensive. Well, they know that the the very emotional money is going to come in right at the end of the market. So we're just going to wait for them. This is not even close to really the unemotional money. It is much more of a, oh my gosh, what's really happening, right? It's a much more drastic approach. Each candle is a lot longer. this is, each week this much volume is going in. This kind of, parabolic move is uneducated money coming into the markets, right? And this is when you're going to start see people are going to start taking their profits like around this level, right? And then they're going to just sit there and watch it as it goes up. And you might be out of the market right here, right? 20, 30% below what the top is going to be, but you can't time the market. It's going to crash below 100 grand because we'll always come back below the fair value number, right? We're going to cross the fair value number. Then we have to test below the fair value as well. And because of that, you could take that 170 grand, again, if you only had one Bitcoin, and now you can take 170 grand and buy Bitcoin at $85,000. And now guess what? You have twice as much now for the next run. And this is really the value of kind of how this trading aspect works. People don't need to day trade. People literally just need to understand, that kind of thing. In 2018, JP Morgan Chase and like 4 hedge funds got together to build a risk model of if we took 1% of our assets and moved it to Bitcoin in 100 different scenarios, how often do we lose? Like, when is it a bad decision and when is it a good decision? And at 1%, it never lost. Up to 5%, it never lost. And the only reason that it didn't lose is because we don't know what it's going to go to. So if Bitcoin goes up to 1 million and then crashes down to 100,000, you're probably going to lose a little something. You know what I mean? But that's also not as likely, right? More importantly, it's predictable. If it goes up to 1 million, you can sell it. $1 million is also a very mental level. Like, you're not going to be like, I'm going to buy Bitcoin. I'm going to sell it when it's 1.176 million. I know that's the number. Like, what the hell? No, you're going to sell it at 1 million or a little under 1 million so that you have an opportunity. But then it'll drop back down and you'll be able to buy it for cheaper. So with that being said, there are plenty of models you can Google and see all the articles on kind of the logic behind why it's smarter to buy 1% worth of Bitcoin than not, because that 1% consistently outperformed every other financial model they had that didn't have Bitcoin. From a generational wealth standpoint, now I'm a little bit different because I'm kind of all in, you know what I mean? Kind of I would say mentally all in. And it's benefited me so much that I used to view real estate this way, and I've just transitioned to actually this is more serving my needs.